Markets are not efficient, but you cannot profit from inefficiency. That is the cruelest paradox in finance. Eugene Fama says prices reflect all information, behavioral finance says bubbles are everywhere. Both are right, yet incomplete. Today we dissect this contradiction, using the half-life of alpha as our scalpel. The efficient market hypothesis, or EMH, comes in three flavors. Weak form says past prices are useless for predicting future returns. Semi-strong form says all public information is already in the price. Strong form says even insider information is reflected. Most academics accept weak and semi-strong, but strong form is a fantasy. The key is that efficiency is a spectrum, not a switch. For example, in weak form efficiency, technical analysis based on historical price patterns would not yield consistent profits, as any patterns would be quickly arbitraged away. Semi-strong efficiency implies that fundamental analysis of public financial statements also fails to beat the market, because that information is instantly incorporated into prices. Strong form, however, would mean that even corporate insiders with non-public information cannot earn abnormal returns, which is contradicted by evidence of insider trading profitability. If markets are mostly efficient, why do anomalies persist? Because of structural frictions, transaction costs, short sale constraints, and behavioral biases like overconfidence and herding. These frictions prevent arbitrageurs from instantly correcting mispricings. For example, the size effect, small caps outperforming large caps, was documented for decades, but it weakened after publication. The anomaly existed, but exploiting it was costly and risky. Transaction costs include commissions, bid-ask spreads, and market impact, which can eat into profits. Short sale constraints limit the ability to bet against overvalued stocks, allowing bubbles to persist. Behavioral biases cause investors to systematically misprice assets, and arbitrageurs may be reluctant to correct these mispricings due to the risk of further mispricing, noise trader risk. Thus, frictions create a window for anomalies to exist, but the window is narrow and hard to exploit. Alpha is the excess return beyond what risk justifies. But alpha is not permanent. We model its decay as an exponential function, alpha at time t equals initial alpha times e to the power of negative lambda times t. Lambda is the decay rate, which depends on how quickly capital flows into the strategy. The half-life, the time for alpha to halve, is the natural log of 2 divided by lambda. This model captures the idea that as more investors adopt a strategy, the mispricing that generates alpha is corrected, and the alpha decays exponentially. For instance, if a strategy has an initial alpha of 10% and a decay rate of 0.2 per year, its half-life is about 3.5 years, meaning after 3.5 years, the alpha would be 5%, and after 7 years, 2.5%. The decay rate is influenced by how easily the strategy can be replicated and how quickly information about it spreads. Alpha dies because exploitation is self-defeating. When a strategy becomes known, capital floods in. More capital means more competition, which narrows the mispricing. The anomaly shrinks until it disappears. This is why factor performance decays, the size effect, value premium, and momentum all show decay after publication. The market learns, and the inefficiency is arbitraged away. For example, the size effect was documented in the early 1980s, and after publication, the premium for small-cap stocks diminished significantly. Similarly, the momentum effect, which was popularized in the 1990s, has seen its returns decline in recent decades. This decay occurs because as more investors implement these strategies, the initial mispricing is corrected, and the excess returns are competed away. The process is a race between arbitrageurs, and the first to exploit an anomaly captures the most alpha. The half-life of alpha is the time it takes for excess return to fall by half. Empirically, many factors show a half-life of 3 to 5 years. This means a strategy that earns 10% alpha today might earn only 5% in 3 years, and 2.5% in 6. The implication is stark: you cannot rely on a single factor forever. For instance, if a value strategy currently yields a 10% annual alpha, with a half-life of 4 years, after 4 years the alpha would be 5%, and after 8 years, 2.5%. This decay is driven by the influx of capital and the increasing competition among investors. As a result, investors must continuously adapt and seek new sources of alpha, as the old ones fade. The half-life concept underscores the dynamic nature of markets and the need for ongoing research and innovation in investment strategies. The debate between passive and active investing hinges on efficiency. Passive investors argue that since markets are efficient, you cannot beat them, so just hold the index. Active investors point to anomalies as proof of inefficiency. The truth is nuanced: markets are mostly efficient, but not perfectly so. The anomalies that exist are small, short-lived, and hard to capture after costs. For example, the momentum effect has been well documented, but implementing a momentum strategy involves frequent trading, which incurs transaction costs that can erode returns. Additionally, the anomalies may be concentrated in certain market segments or time periods, making them unreliable. Passive investing, on the other hand, offers low costs and broad diversification, which is often sufficient for most investors. The debate is not about whether inefficiencies exist, but whether they are exploitable after costs and risks. If alpha decays, how do quants survive? By being faster than the crowd. The edge is not a secret formula, it is the ability to identify a nascent inefficiency before others, and to exit before it vanishes. This requires continuous research, advanced data, and rapid execution. The half-life of alpha is the clock ticking against every strategy. For instance, a quant fund might use satellite imagery to estimate retail traffic and predict earnings surprises. This data is not widely available, giving the fund a temporary edge. However, as more funds adopt similar data sources, the edge diminishes. To stay ahead, quants must constantly innovate, developing new data sources and models. Speed is also crucial. Executing trades quickly can capture alpha before prices adjust. Thus, the competitive landscape is a race against time, where the half-life of alpha determines the window of opportunity. Chasing alpha has a cost. The net alpha is gross alpha minus transaction costs and fees. If gross alpha is 10%, but costs are 8%, net alpha is only 2%. This is why many active funds underperform. The formula is simple: net alpha equals gross alpha, costs. The challenge is that costs are certain, while alpha is uncertain. For example, an actively managed mutual fund might have a gross return of 12% per year, but after management fees of 1.5% and transaction costs of 2%, the net return to investors is only 8.5%, which might be lower than a low-cost index fund returning 10%. Over time, the compounding effect of higher costs can significantly reduce an investor's wealth. Therefore, even if an active manager has skill, the costs can erode the excess returns, making it difficult to outperform a passive benchmark after fees. For individual investors, the takeaway is sobering. Trying to beat the market is a zero-sum game after costs. Most active managers fail to outperform. The evidence suggests that low-cost passive investing is the rational default. But for those with the resources and speed, there are pockets of inefficiency to exploit, albeit briefly. For instance, studies show that over a 15-year period, only about 20% of active large-cap fund managers beat their benchmark after fees. This is partly because the costs of active management, including trading and research, eat into returns. Passive investing, such as buying an S&P 500 index fund, offers market returns minus minimal fees, which often outperforms most active funds. However, for institutional investors with access to sophisticated strategies and low execution costs, there may be opportunities to capture alpha, but these are limited and require significant expertise. As technology improves, markets become more efficient. Algorithmic trading and data analytics reduce mispricings. But new inefficiencies emerge from new technologies and regulations. The cycle continues: inefficiency, exploitation, decay, and new inefficiency. The market is a moving target, and the only constant is change. For example, the rise of high-frequency trading has reduced bid-ask spreads and improved price discovery, making markets more efficient. However, new technologies like cryptocurrencies and decentralized finance have created new markets with inefficiencies due to regulatory gaps and information asymmetries. Similarly, changes in regulations, such as the introduction of new disclosure requirements, can create temporary mispricings as investors adjust. Thus, while efficiency increases in some areas, new opportunities for alpha arise in others, perpetuating the cycle. So, is the market efficient? Yes, mostly. But not perfectly. And the imperfections are not a free lunch. They are fleeting, costly to capture, and quickly arbitraged away. The paradox resolves into a practical truth: for most investors, accept efficiency and invest passively. For the few with speed and resources, the game is to find the next inefficiency before it dies. The half-life of alpha is the clock that governs all. The key is to recognize that while markets are not perfectly efficient, the inefficiencies that exist are not easily exploitable. For the average investor, a passive approach is likely to yield better results after costs. For the sophisticated investor, the challenge is to stay ahead of the decay curve, continuously innovating to capture alpha before it disappears. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.